If you've been waiting to see what the news is telling us about what's ahead for our housing markets in 2024, there's now quite a few clues with regard to interest rates, inflation, building approvals, and what's actually happening on the ground each weekend with auctions, which is a great in-time indicator. We're going to be discussing all those things with Dr. Andrew Wilson, Australia's leading housing economist, in this week's Property Insider Chat. And at the end, you're going to have some idea of where our markets are heading. But if you want to keep up to date with our regular market updates, please subscribe to this YouTube channel and click the little bell icon so we can inform you each time a new show comes out. Believe it or not, we're already 1/10 through the way of this new year, 2024. And as somebody interested in property, you're likely to be wondering what's ahead for our housing markets. Well, there's been lots of clues in the news over the last week or two, and I'd like to discuss these with Dr. Andrew Wilson, Australia's leading housing market economist, including the Reserve Bank's February rate decision, what that means for interest rates moving forward, what's likely to happen with inflation, the latest building approvals, and of course, how our auction markets have started the year. Putting all these together should give us some indication of what's ahead. Hello, Andrew.
Yes, good morning, Michael. And we are well and truly into the year now. We're consolidating our early housing market data, of course, through the auction market, the weekend auction market. And the results have been particularly interesting over the last fortnight. We've had our first interest rate decision for the year, which I think was particularly challenging for those predicting perhaps the prospect rather than later of lower interest rates. I think the Reserve Bank knocked that one on the head pretty rapidly or pretty succinctly. And the economy continues to perform well. So no real change other than the fact that I think the more positives continue to outweigh the negatives. And when we're speaking about positives, lower interest rates, although it is better, of course, for mortgage holders, from the point of view of the macro economy, is not really a positive story. So we all move on.
Well, it's old news now, even though it's only a week old, that the Reserve Bank has held interest rates steady for the month. But that was expected by almost everybody, Andrew. While the policy decision was well anticipated, what did the Reserve Bank's commentary suggest about what's ahead for the rates?
Well, you're right, Michael. Of course, no surprise that rates were put on hold for the second consecutive months. Of course, we did have an increase over November, Melbourne Cup Day, when we'd had consecutive monthly rises in inflation. That sort of set the Reserve Bank's strategy on its heels to some degree. So we had an increase in interest rates, but December was on hold, and now we have the first meeting of the year, February, on hold again, which, as you said, was absolutely no surprise. The jobless rate remains very low, near record low levels. We're still creating a lot of jobs. The unemployment numbers are falling, and the participation rate is still at near record highs. Of course, the labour market's being fueled by high numbers of new migrants. So that's why we're seeing more jobs and perhaps a little bit of an uptick in the unemployment rate, which is still at near record low levels. But of course, we're absorbing hundreds of thousands of new entrants. So no surprise there, the unemployment rate is a little bit higher. And the participation rate also fell slightly from those near record highs. But again, no surprise with fewer people engaged from the potential labour market in the real labour market. We also have retail sales are still high. They're not growing at the rate they were last year, which was still being fueled by the COVID stimulus packages. But they're still high, and they remain significantly above the pre-COVID levels, even regarding the influence of migration and inflation on the data. Inflation, we had the latest inflation data out, which we'll look at in a minute, which is lower and falling, which is good news, but it's still too high when we look at what the target range is. And those drivers of inflation are still housing, food and fuel. But the big picture is, I think, that rates are likely to remain on hold for the foreseeable future.
Well, Andrew, it seems like the media was looking for the Reserve Bank governor to say that interest rates were going to fall, but she said she's not ruling anything in or out, and that's not surprising, although we might have liked her to say interest rates are on the way down. That could have made us more confident and started us buying more, borrowing more. That would have had an inflationary effect, wouldn't it?
Well, absolutely. And the issue with lower interest rates is that it is inflationary. It's designed to be inflationary. It's designed to have people out there spending again. And as we looked at that data, there's just no justification for lower rates. We still have a very strong economy. Inflation's still high. People are still spending. So why would we be talking about lower rates? It's just nonsensical. And the same debate's going on in the US at the moment, where all the markets and the commentators were all predicting a cut in rates. In fact, there was a 100% chance, according to the markets in the US at the end of last year, that there would be a cut in the March meeting of the Federal Reserve. Those odds are now just about zero, Michael. So I'm not sure how you go from 100% likelihood of something and it's not happening, because 100% is 100%, but that just shows you the nonsense that we get, particularly in the financial media, which has been driven by other agendas. And let's hope people aren't making decisions based on particularly these predictions of lower interest rates in the near term. The Reserve Bank was, I thought, particularly pessimistic in regard to the outlook. I think the key comment that was made in regard to the February decision on the day was that, and I quote this, while recent data indicate that inflation is easing, it remains high. The board expects that it will be some time yet before inflation is sustainably in the target range. I emphasise that, some time yet. The path of interest rates that will best ensure that inflation returns to target in a reasonable time frame will depend on the data and the evolving assessment of risks, which of course is a logical statement. But the commentary ended off by saying a further increase in interest rates cannot be ruled out. I think that was quite pointed. The fact that the Reserve Bank's mention of the future direction of interest rates was about a rise, not a fall, and that an increase cannot be ruled out. So read what you want to into that particular statement, Michael, but I think that that's clearly saying those predicting lower rates in the near term need to take a cold shower.
The Reserve Bank's really only got two ways of controlling inflation. One is interest rates, and the other is the rhetoric, what it says and how it makes consumers feel. So yes, it would be wrong to have said interest rates are going to fall anytime soon. Looking back over the last 4 decades, how long it's actually taken interest rates to start falling from when they reach their peak on average, it's actually been 10 months. So even if we just look at what's happened in the past, interest rates peaked in November. It's going to be quite some time before interest rates are heading down, even though one of our big banks is already suggesting, the CBA is suggesting 3 interest rate falls this year, the first one starting in May. Yeah, I think a bit out of line with the other commentators.
Well, I'm not sure we should be using the economic forecasts of the big banks as any sort of credible outlook into the future. I think the most consistent position of the big banks is that they get it wrong just about all the time. So, but again, banks are always about changing interest rates. We know margins have changed significantly against the changes in official rates over the last decade. So obviously, they're making corporate decisions based on their hope that interest rates will change so that they can play their games with changes in margins, in my opinion. But nonetheless, as I said, these things, when we look at the media particularly, it's all about clickbait, the predictions. Something's got to happen. You know, nothing worse than everything remaining the same, you know. But I'd be very wary of taking any seriousness of these predictions of lower interest rates. It's made a lot of commentators and economists in the US look very foolish, but they should be used to that. They've been looking foolish really for years because of those predictions that were made about a cut to come in March. And I think that media just follows perhaps the pattern of what's happening in the US in terms of the conversation. But I thought that commentary by the governor, the RBA governor, in regard to the decision was particularly pessimistic, but not surprising, given, as we just discussed before, how strong our economy is. And really, these aren't the circumstances when you're still at around about 4% underlying, well ahead of the 2 to 3% target. I think we need to have a consistent period with an inflation rate with a 2 ahead of it. That's the underlying inflation rate before the Reserve Bank would consider cutting rates. And even they themselves have said that's years off.
Your chart here is showing how inflation has fallen from its peak of 7.2%, so it's heading in the right direction. But your next chart's actually fascinating. You bring this up reasonably often, how inflation tracks oil prices, Andrew.
It is quite an interesting relationship, Michael, and the latest inflation data, the monthly inflation data, did have another substantial fall, down from 4.3% to 3.4%. This is the December monthly data, and that followed a fall over November from 4.9 to 4.3. So we've seen inflation fall from 4.9 to 3.4 over 2 months. Underlying inflation was lower again, down to 4%. But as I said, the target is 2 to 3%. So we're still reasonably well ahead of that, but it's certainly heading in the right direction, Michael. And the significant contributors are, again, housing over December. We really don't have any relief in sight for high rents, which are a significant contributor to CPI's housing basket of goods. But we are seeing the house building costs starting to fall, which is good news, but they're still also high. Transport fuel costs were actually up sharply over December compared to November, by 5.3%. And they do tend to be a bit volatile at the moment, but they fell 2.3%, or they're up 2.3% the previous month. So it was a sharp increase compared to the previous month's increase. But as I mentioned, we're still well above the target range, but certainly inarguably moving in the right direction. But we've still got some way to go. And we all hope, of course, that we find our way sooner rather than later to the target range. But as you mentioned, Michael, it's interesting when we do track the price of oil versus the inflation rate. It's the same in Australia as it is the US and other advanced economies. We've seen the inflation rate fall almost link by link with the oil price. Of course, it doesn't fall in the same time frame, but when we move the time frames to match, we can see there's a very strong relationship between falling inflation and falling oil prices. And when we just look at perhaps the peaks of the cycle to compare it, the oil price since its peak last year has declined by 37%, whereas the CPI has declined by 44%. So a very similar decline in the inflation rate to the decline in the oil price. So perhaps that begs the question, why did we have to raise interest rates at all? But that's a debate for another time, perhaps, Michael, because if it's all about the price of oil, we could have left interest rates low, but it's a bit of a guessing game, a lot of these policymakers' decisions, and they have to do something, of course, and they couldn't have risked a wages price spiral, which maybe nonetheless is sort of there in slight terms, given the impetus of higher interest rates on the demand for wages and having that as a generator of higher prices. But we move on, and the inflation data certainly has improved significantly in line with oil and is heading now back towards that target range. Hopefully we get there sooner rather than later, but the Reserve Bank has quite clearly said that it's not satisfied where things are yet.
One of the stories that's not going to go away this year is the housing shortage for properties to buy as well as properties to rent. So we take interest in the dwelling approval data that the ABS brings out on a regular basis. Of course, we recognise that just because buildings are being approved, especially apartments, they don't come out of the ground because currently they're financially unviable. They just don't stack up with their higher cost of living. And in general, I mean, we know that the government wants us to build more medium and high density dwellings. So what's happening, Andrew? What is happening with approvals?
Well, we had some interesting data from the ABS over December, Michael. The building approvals, it was interesting because we've had consecutive months, October and November, of higher building approvals, and that had started to work its way into the trend. And maybe there was a sense that we'd actually reached the bottom of the shakeout in the house or the home building cycle that's been evident really for quite some time now. So consecutive quarters of increases, yes, it was driven by that volatile unit sector, but nonetheless, things were starting perhaps moving in the right direction in terms of bottoming out of our declining building cycle. But unfortunately, the latest data bounced back again. Home approvals collapsed, and by that I mean that they bounced down again. We're down by 10.6% over December, following a 1.6% November rise. It was about units again. They were down by 25.3%. And as we mentioned, volatile units, you can get a big development that picks up data from month to month. And of course, the next month, if you don't have that same big development, or a similar big development, it pushes the data downwards. But houses were also down over the month, down by 0.5%. Queensland was the top state, up by 8.2%. But certainly annual growth levels remain chronically depressed. And when we look at the comparisons, we had units down 25.3%, houses down 0.5%, and total dwelling approvals down 10.6% nationally. But when we look at the year to date, and that's the full year results, we can see that we're still significantly below the year before, 2023 versus 2020. And the overall trend in building approvals, national building approvals, is still down 38.8% since the 2016 peak. And that trend, Michael, continues to decline. So we're not really seeing any relief in the data for building approvals, continuing to fall despite some ups and downs from the month. And that is very bad news because, as we know, we are a chronically undersupplied housing market. And when we look at units versus houses, we can see trend for unit approvals on the capital city markets are down by 55.9% annual trend versus the peak back in 2016. That's a remarkable collapse.
If you think about it, the government's saying that they want us to build more units and affordable ones, but how does it work when you're actually talking about building where the land is the most expensive and also using a construction technique that's much more expensive to build apartments, especially medium and high-rise ones, and now with the stricter building codes, considering all the challenges with poor building quality before, it's only going to mean new construction is going to be more expensive, not affordable.
Well, as I said, the trend is still falling. When we see the unit trend and compare that to what it was in the years following its peak, or certainly around its peak years in 2016, it's almost unbelievable to see how the number of units that are being approved is so much lower than what it was nearly a decade ago. Is that there's just no short-term, maybe even medium-term solution to this problem, and it just means really living with this issue of being undersupplied on a permanent basis, and it's only going to mean higher prices and rents going forward, sadly, particularly for tenants.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. We each week look at what's happening on the ground in our auction markets because that gives us a good indication of the feel of and depth of buyer and seller sentiment. Each week, the number of auctions is building up now, giving us a better indication. What happened last weekend, Andrew?
Well, it's the second weekend of the auction season. Really, auction season doesn't start until the first weekend in February, Michael. And that's when we start to see the number of properties being relevant enough to give us a substantial clearance rate and reflecting what's happening in the market. The reason we do look at those weekend auction market results is that they are a very positive and a very predictable indication of what's happening in housing markets generally in those particular capitals. And we can see that house prices and clearance rates in Melbourne and Sydney do track each other almost one-on-one. So for those interested in what's happening in the market, it's a useful exercise every weekend to look at those weekend auction results. And as I said, we've had our second weekend now, Michael. Of course, the first weekend can always be perhaps, okay, we need something to consolidate or substantiate the first weekend's results. The first weekend, Michael, was particularly strong. We had higher auction numbers compared to the first weekend last year, and clearance rates were also generally higher as well. So it was a very positive start to the year. Auction markets typically start the year off, Michael, where they finish the previous year. So we're thinking, okay, good start to the year, particularly for sellers with higher numbers of properties on the market and a higher clearance rate. But of course, one swallow doesn't make a spring, I suppose you could say, Michael. So we needed to have a little bit of a follow-up. So I guess we're waiting with a sense, perhaps, I won't say bated breath, but interesting to see the second week result. It was a particularly strong follow-up weekend last weekend in the auction markets. Sydney had another very big weekend of auctions for the early season market. 688 auctions in Sydney. That was up from 540 the previous weekend and well ahead of the 541 auctioned over the same weekend last year. And a clearance rate, Michael, of 77.2%. Again, higher than last weekend and higher than the same weekend last year. And when we're starting to move above 75%, that really is indicating potentially strong prices growth. We always use 80% as a benchmark for that boom word. We're not at a boom, but we're certainly pushing towards 80% with these results. And as I said, the results were consolidation and a confirmation of what we saw over the first weekend. Similarly, in Melbourne, quite a reasonable weekend for auction numbers in Melbourne. Michael, 577 auctions in Melbourne, up from the previous weekend's 423 and higher again than the same weekend last year. And quite a solid clearance rate in Melbourne, 72.1%, again higher than the previous weekend and well above the same weekend last year. Brisbane had fewer auctions last weekend compared to the previous weekend, but another strong clearance rate, or a strong clearance rate for Brisbane, which does tend to have volatile results because it has a different culture in a sense to how it conducts an auction, but still ahead of where it was last year in terms of the auction clearance rate and the number of auctions. Adelaide down also a little bit compared to the previous weekend on auction numbers, but its clearance rate was just under 80%, but lower than where it was a year ago. And of course, we know last year Adelaide had a particularly strong auction market with most weekends producing 80% plus results. And Canberra, which has been a clear underperformer in terms of auction activity last year compared to the other capitals, 46 auctions, well down the previous weekend. But its clearance rate was higher at 57.9%, lower than the same time last year with their auction numbers also lower. So I think, Michael, when we look at the trends over the past 12 months, clearly all the markets, with the exception of Canberra, are tracking ahead of where they were at the same time last year. And I think these are very positive results, Michael. Now, a little bit of context, when we look at Melbourne and Sydney, I'm not surprised. We've discussed the potential for more growth in Melbourne and Sydney this year, because we need to understand that the Sydney market is still just below where it was in terms of prices nearly 2 years ago, Michael. So there's still value in that Sydney market. And Melbourne's around about 4% below it was where it was around 2 years ago. So there's plenty of value opportunities still in those markets. And I think that goes some way to explaining why we're seeing a strong start to the year. Still value opportunities, strong economy, higher levels of migrants, and plenty of certainly motivation, particularly for first home buyers, to get into the market, given how high those rents are at the moment. So I thought it was a very positive results, Michael, at the weekend. And it wasn't just the clearance rates. It's the fact that we're seeing significantly higher numbers of sellers, particularly in that Melbourne and Sydney market, Michael. We can't say that this has been driven by fear or a shakeout. I think it's just confidence that sellers want to take advantage of what are still good competitive markets for buyers out there.
Well, buyer and seller confidence is what's going to drive our markets in 2024. I found in general buyer confidence comes first, and that started to show at the end of last year. The number of sellers currently putting properties for auction was related to the sentiment that they felt going into Christmas time, getting ready for auctions now. So I agree with you. I can see moving forward, more properties are going to come on the market. And it's almost a self-fulfilling prophecy, because sellers are looking for more properties to buy. I mean, most sellers are buyers, so they're saying, oh, look, there's more there. I can actually find somewhere I can move to. I feel confident now. And so we're going to have another good year in property, aren't we?
Yeah, particularly with those value opportunities still very much in play.
Particularly in Melbourne, yes. Well, if you look at it, we mentioned a while ago how much extra it's going to cost to build new properties, which really means established properties have got an inherent inbuilt equity, because you couldn't replace many properties at what the market's currently prepared to pay for them. It's just a stage of the cycle, and in due course, the cycle will move on, Andrew.
Exactly. And it is about affordability, Michael. And as we mentioned, there's still good affordability in those Melbourne and Sydney markets, which means there's plenty of upside for higher prices.
Great. Well, we'll be back again each week. Look forward to catching up with you next week and hearing the latest news.
Thanks, Michael.